Warren checks his phone before the coffee finishes, because markets don't wait. Meta is trending everywhere. Headlines say the stock jumped after earnings, and people are already fighting about AI hype. Warren scrolls and sees the number that matters, up around 10% after hours. He expects a scary explanation. Instead, he sees a bigger shock. Meta plans to spend between $115 billion and $135 billion on AI-related Capex in 2026, far above last year. That number is so large it stops sounding like money. It sounds like a weather event. And Wall Street didn't punish it. It cheered. That's the part that messes with your brain, because your instinct says if spending explodes, the stock should drop. But in 2026, the market often rewards whoever can afford the war. Meta's message was basically, we have the cash to keep swinging. Not forever, just long enough to try to win. Warren thinks, wait, didn't investors complain about this spending spree all through 2025? They did, but this quarter, the ad business showed up like a bouncer at the door. Advertising was the hero again, with Reuters reporting a 24% surge in ad revenue for the quarter. So Meta basically said, we can fund the moonshot and still throw off billions in cash. That's why the market relaxed. And that is the trap. Here's the paradox in one line. Meta is spending like a company in trouble and trading like a company in control. That mismatch is where retail investors get hurt, because a stock pop can hide a business risk. Let's name the risk, the Capex trap. It's when investment turns into a blank check that only looks smart while the core keeps winning. As long as the core prints money, the spending feels strategic. When the core slows, the exact same spending looks reckless overnight. And that flip can happen faster than your portfolio can react. In 2026, AI spending isn't a side project anymore. It's the product pipeline. It's the competitive moat. It's the arms race. Meta is telling you the battlefield is compute. Data centers, chips, power, cooling, and control. Whoever controls the machines gets to set the pace. Meta's latest results gave investors comfort, not because AI paid off, but because ads did. CNBC reported Meta beat expectations on the top and bottom line, with online ads doing most of the lifting. Reuters also pointed to the same thing. The core engine is still strong, and that core engine buys Zuckerberg time. One portfolio manager quoted by Reuters put it bluntly, the big returns are still coming from the core business, not from generative AI revenue. At least not yet. But the irony is that the AI infrastructure can still improve ads, targeting, and automation, which feeds the core again. That loop is why investors keep giving Meta room. On the call, Zuckerberg framed 2026 as a major year for building what he calls personal superintelligence. That phrase matters because it's not a product description. It's a permission slip. It gives Meta room to spend massive money before revenue is obvious. Now look at what that spending actually is. It's not one new app. It's power, racks, cooling, networking, land, and warehouses full of servers. It's also payments to third-party cloud providers when internal capacity runs out. Reuters said the Capex range was driven by infrastructure costs, cloud payments, depreciation, and higher operating expenses. Meta CFO Susan Lee used a phrase that explains the urgency. Capacity constrained, corporate language for we're out of compute and still hungry. Lee said Meta ramped infrastructure through 2025, but demand for compute resources across the company rose even faster than supply. So Meta is building new data centers while renting capacity in the meantime. Reuters reported Meta signed contracts with providers like Alphabet, CoreWeave, and Nebius to expand compute. Here's what most people miss. Capex isn't just a one-time hit. It turns into depreciation, which drags on profits quarter after quarter. So today's build-out becomes tomorrow's fixed cost. And that's why the big question still hangs in the air. What does Meta sell that directly pays for all this AI build-out, beyond better ads and better engagement? Zuckerberg didn't give a neat answer. He said they're building a lot of things, not launching one single magic product. That sounds flexible. It also sounds like uncertainty, because a lot of things isn't a revenue model. Eventually, Wall Street wants a scoreboard. Meta's strategy has also looked messier than some competitors, but it's a deliberate mess. Zuckerberg is betting that owning the foundation model matters more than looking tidy. He argued that if Meta relies on others, Meta gets constrained by someone else's roadmap. In other words, if you don't own the engine, you rent your future. That's why Meta made big moves to pull talent and capability closer. CNBC reported Meta invested $14.3 billion in Scale AI, bringing Alexandra Wang and key researchers into the orbit. CNBC also reported Meta has tested a frontier model codenamed Avocado as a potential successor path beyond the Llama family. That's a signal. In 2026, this is not just a chip war. It's a talent war too, and talent isn't cheap. Reuters said Meta expects higher expenses in 2026 as it hires aggressively for AI. So Meta is paying for machines and people at the same time. Investors are tolerating it right now for one reason. The ad machine is still paying the bills. As long as the core throws off cash, Meta gets leeway to chase the next platform shift. Reuters also described how this kind of spend can squeeze profitability even when revenue grows. If Capex and costs rise faster than sales, operating margin takes the hit. And that matters because margins are what pay for buybacks, dividends, and future flexibility. Meta can afford a margin dent while ads are hot. But if the ad cycle cools, the same dent can become a crack. Then there's competition pressure. Meta's ad empire lives and dies by attention. Instagram Reels fights for the same short video minutes as TikTok and YouTube Shorts. WhatsApp and Threads monetization adds new revenue lanes, but it also pulls Meta into more direct rivalry. And rivalry means you can't just spend on AI. You still have to defend the feed. But the market's patience is fragile. Reuters pointed to Microsoft as an example of the rule. Core growth still matters. When investors get nervous about the core, AI spending stops looking heroic and starts looking scary. And the ripple effects go beyond Meta. Yahoo Finance described the broader AI market as boom-like, with huge spending spreading across the industry. Bloomberg's reporting described hyperscalers spending real money on real infrastructure, and suppliers feeling it. But the same boom creates bottlenecks. Demand can outstrip supply, not only for high-end accelerators, but even for basic memory. That's how an arms race becomes a global constraint. So what does Warren do with this in 2026? He doesn't chase the green candle. He builds a filter. First, he separates the core cash engine from the moonshot story. If ads slow, the entire risk profile changes immediately. Second, he watches Capex relative to revenue, not Capex in isolation. Third, he watches operating margin and free cash flow, because hype doesn't pay bills, cash does. Fourth, he treats superintelligence as a marketing word until it becomes a product line with revenue. And if Warren already owns the stock, he asks one boring question. Is the core business still strong enough to fund the war? This is education, not personal financial advice. Always verify the latest numbers and risks before acting on any headline.